It is the biggest month-on-month and year-on-year increase for CPI since January. CNBC senior economics reporter Steve Leishman joins us this morning with some new ways of looking through these numbers. Hey, Steve.
Hey, Carl. Yeah, welcome to our new augmented realities set here. Talk about this firm inflation number that the Fed is expected to look through because of the gathering concern about the labor market. But this spike in jobless claims may be partly seasonal. We'll come back to that in a second. Here's the data right here. Up 0.4. That's a 0.2 higher than last month. That raised the year over year 2.9% versus 2.7 in July. Looking at the core, right in line, but still somewhat elevated here. 0.3 on the month over month, same as July. And then 3.1, same as July on the year over year. But now take a look at some of the internals here. Auto repairs up 2.4%. People holding on to their cars maybe a little bit longer. You can see down there in the bottom right, used cars up 1%. Tool appliances, a little bit of a tariff effect there. And airline fares up 5.9%. I thought that was a little curious given that we've had some decline in the in travel here. Now those jobless claims numbers, big spike, but went back and looked, you could see it's from 236 up to 263. But a lot of that, folks, if you look at the next screen here, Texas up 15,000, maybe some adjustment when it comes to the start of the school year. We've seen spikes in this week back the last 3 years. What's the market do with all this data? Let's put it together. Take a look at the Fed fund futures. September, 100% with a 10% chance of a 50. Not much change on today's data. October, 92%. And then December, you can see right there at 85%. So good confidence of 3 rate cuts this year.
Oh, let's take that back. Because this might be a problem if inflation continues to stay elevated, right? They are expecting, and the stock market as a whole, the market as a whole is expecting 3 rate cuts, right? One in September coming up next week, October, 92%, as well as December to end the year at 85%. So this is saying that more than likely they're expecting, an expectation is 25 basis rate cut September, October, and December. That would put us at a 3/4 of a point rate cut, right? 0.75% to the Fed's fund rate that we currently are sitting at right now. That would lower interest rates significantly when it comes to not just mortgage rates, but just rates overall in general. When it comes to you going to a bank, you buying a car, and any type of loan that you're basically looking at getting from a bank, right? So this is very important. However, if inflation stays high and the employment situation cools down a little bit, then the Fed is going to have to make a decision on if they want to continue to lower interest rates or pause, right? So the key is not just taking the cut and running with it. The key is listening to what Jerome Powell, which is the federal chair, is going to report and say in the meeting next week when he does the press conference. What does he say? Right? Does he say that, we lowered interest rates because we have an unemployment issue, but we still have sticky inflation due to tariffs and other variables, so we're going to wait and see for future guidance? Or does he say that for future guidance, he sees a possible rate cut in October as well as December